Welcome to Driving Alpha, where we feature our friends, the outperforming investors who demonstrate their path to driving alpha or outsized investment returns. We're Alpha Partners, where we partner with 1,000 early-stage venture firms as their opportunity capital to invest in their best companies. Driving Alpha is supported by Affinity, provider of the CRM for the private capital relationship economy. Affinity knows who has the best relationship with the right startup. Affinity knows. Learn more at affinity.co/driving alpha.
Hi, I'm Steve Brotman, as the host of Driving Alpha, which is a podcast that delves into the personal histories and investment strategies of venture capitalists. I'm excited to introduce our guest today, Charles Hudson. Charles is the managing partner and founder of Precursor Ventures, an early-stage venture capital firm based in San Francisco. With over 15 years of experience in VC, Charles has established himself as a prominent figure in the seed stage investing community. Adding to his impressive credentials, Charles served last year on the chair of the board of directors of the NVCA, the National Venture Capital Association, a role he assumed in May 2023. Before founding Precursor Ventures in 2015, Charles was a partner at SoftTech VC, focused on mobile infrastructure, applications, and marketplaces. His entrepreneurial journey includes co-founding Bionic Panda Games, an Android-focused mobile game startup. And Charles' career in technology investing began at In-Q-Tel, the strategic venture capital group for the Central Intelligence Agency, the CIA. At Precursor Ventures, Charles has raised 4 funds and currently manages over $175 million in assets. The firm specializes in companies' first round of institutional funding, typically investing between $250,000 and $500,000. Some of Charles's notable investments include Shippo, The Athletic, Incredible Health, Juniper Square, and Modern Health. Charles is renowned for his commitment to investing in diverse founders, has been recognized for his efforts to support underrepresented entrepreneurs in the tech industry. With his extensive experience, unique investment philosophy, and commitment to diversity, Charles Hudson has become a respected voice in the venture capital community, and I'm thrilled to have him on the Driving Alpha podcast to discuss his personal history, investment highlights, and the edge he brings to the world of venture capital. So thank you, Charles, for joining us.
Thanks for having me. I'm so excited to be here. I've really enjoyed following the journey of the podcast, and I really like some of the episodes I've been able to listen to lately.
Awesome. Thanks, Charles. That's kind of you to say so. It has been kind of fun. And, we do have a little bit of a unique role as we work with over half of all VCs. And I've been so excited to get to know you over the last few months even. And part of our inspiration of doing this was, just some of the conversations I'd have with VCs. I do about 50 different calls a month. I felt were just too good to be private. And so thank you for agreeing to join us.
Yeah, it's a real honor.
I was just thinking what would be pretty cool is to hear a little bit more about your backstory. Yeah. A lot of folks think about what you're doing in venture. It'd be great for you. I told a little bit about that up front, but if you could share a little bit, it sounds like you started your career as an entrepreneur. Is that right?
I was an entrepreneur in high school and in college. And then for those of you who remember Internet 1.0, I worked for a little company called Excite, and, one of the early search engine pioneers. And I had a great time there. And while I was there, I met a bunch of really talented folks, one of whom introduced me to the gentleman who was Gilman Louie, who was running In-Q-Tel at the time. And I didn't know anything about venture capital. I was pretty sure. It's funny, Steve, I actually wanted to become a public equities portfolio manager in college. I was like one of those college kids that traded stocks before Robinhood and E-Trade and all those things. I was just really into stocks. I liked studying companies and figuring out which ones I thought were interesting. And I said, maybe I can make a career of this on Wall Street. And the tech thing was a lark because I was at Stanford in the late 90s, early 2000s. And if you didn't work in tech, you sort of didn't get the memo of what was happening around you. Yeah, I went and worked at Excite. I was like, this is really cool. I want to do more of this.
Did you meet Joe Kraus by chance? Or
I did. I worked in Joe's group. So
That's
I met
amazing.
Joe. It was, yeah, he was a really phenomenal entrepreneur. It was like one of my first up close and personal experiences with a super talented entrepreneur. So I was an intern in Joe's group. We had many other people who've gone on to do great things. Sam Shank was in our group, who started Hotel Tonight and has been a great career in the world of travel. Raj Kapoor, who was at Lyft and has his own climate fund now. Jeff Donaker, who was very senior at Yelp and now is one of the partners at BurstCat. I mean, I could go on and on and on. There were a ton of really talented, interesting people working in that company. And I thought, wow, the internet is a big deal. It's pretty cool. And then I was just like, well, who funds these companies? Like, where do these internet companies get? The funny thing was I was an intern in our fledgling e-commerce product. So all of these venture-backed startups would come in and meet with our group looking for homepage placement on our shopping channel. And so I'd meet these companies. They'd come in. I'd be like, what does your company do? Oh, you sell candles online. That's pretty cool. Wow, you raised $50 million to sell candles online. Okay, that's interesting. And through the time there, I just got really interested in entrepreneurship and thought about joining actually a very, very early venture studio, and then learned about In-Q-Tel through one of my friends at Excite. And she put me in touch with the person who was running In-Q-Tel. And he said, the government, it's like it's been an hour talking about that, but the basic idea of the government was not really plugged into Silicon Valley with all the new innovation that was happening, partially because they were 3,000 miles away, but also partially because government contracting and the process of procurement was really not something startups understood well. And I'd also say a lot of VCs said the government's a bad customer. They'll just bog you down. There's no need to engage with them. And I'd like to think In-Q-Tel played a role in changing the perception of what startups could do working with the government.
What year was that?
I joined in 2000.
Okay.
I was there from 2000 to 2004.
Very cool. That's pretty early on in the whole GovTech arena.
Yeah.
And it's only been recent that, I've been in venture for 25 years, late 99 myself I started after I was an entrepreneur. I've not touched the military or government side. So In-Q-Tel, you were there for 4 years. I bet you got to see a lot of pretty cool stuff. Did you have clearance there?
I did.
So
I
you
no
still
longer
have it, or do you?
I no longer do. I surrendered it. I tell everybody, be careful what you know. Like, you learn a lot of things. And I was like, I think I was a happier, more chill person before I knew all of these like really scary things that were happening in the world. But that job was a lot easier with clearances. It became a lot easier.
And so what prompted you to move on?
I think what I recognized was, In-Q-Tel was my first job out of college. I felt like I'd learned a ton. And when I looked around, I was like, the next level of working with startup founders really does, like, I want to be more credible. I want to actually be able to advise people. And I said, I have effectively zero working experience outside of this job. I don't really know that I'm ready to start advising CEOs on strategy. I've never hired or fired anybody. There's just a bunch of entrepreneurial experiences I want to have before I come back to venture, but I think this is a job I'll return to. So I went to business school kind of because I looked at a bunch of other venture jobs, which made me realize how great I had it at In-Q-Tel. Like, I had a lot of autonomy and freedom. I thought business school would be a great place to just get a survey of like, well, what are the other jobs out there? What does it mean to be a product manager? What does it mean to be in marketing? What does it mean to be in sales? And I really got a lot out of business school. I really did.
That's great. If you're going to go away for a year and a half, you might as well, suck the marrow out of that. Where'd you end up?
So I went to Stanford largely because I connected with like the vibe on campus, but also I knew I wanted to stay in the tech ecosystem. And I felt that going to business school in the backyard of the tech and venture ecosystem would make it easy to stay plugged in. And that was largely true.
And so what'd you do after?
I went to work for a company called IronPort Systems that was in the email security space because I wanted to try my hand at product management. And they were kind enough to give a non-technical econ and Spanish major the opportunity to try his hand at product management. And I tried it, and I quickly realized I was probably never going to be an amazing product manager. I have so much respect for people who are good at that job. I wrote a few PRDs. I helped ship a few products. But I also worked with a group of people who I thought were so much better at this job than I was that I couldn't envision how we would close the gap. And those folks have gone on to do, many of them were VP, SVP level product people at private companies and public companies, which gave me some confidence that my assessment of the gap between me and them was grounded in reality.
Great. Let's see if we can't fast forward a little bit to Precursor. Like, how did you end up founding Precursor and
Yeah.
attorney go from IronPort to...
I then sort of tried a bunch of other things. I knew product management wasn't right. I tried BD at Google. I really liked business development. So did that, ended up doing biz dev and revenue stuff for some companies in the game space, the last of which we sold to Zynga. After we sold that company to Zynga, I had been thinking about getting back into the VC landscape, and I'd been talking to a number of firms, and I'd known Jeff Clavier at Uncork from his days at Runners. And I went to him and said, hey, I'm talking to a few other firms. I'm looking for some advice. I've never looked under the hood of a venture firm. Am I asking the right questions about what it means to join one of these things? And he goes, yeah, you're asking the right questions. Maybe you and I should work together. And we started looking at deals together. At the same time, in the background, I was working on a startup idea for a games company with someone I'd worked with before. And he and I went pretty far down the rabbit hole. And I said, hey, look, can I be a venture partner at Uncork while I work on this startup idea? And I did that for about 2 years. Every time I talked to a founder who's like, I want to run a fund on the side while operating a company, I'm like, please don't do it. It's so hard. I'm very fortunate that Jeff did so much of the heavy lifting at Uncork, but it's really hard to be all in venture and also all in on it's just hard. So that startup ran its course, and I went back to full-time investing. And when I joined Uncork, we had a pretty small fund, and we were doing seed investing back in 2010. And the irony is seed investing in 2010 looks a lot like pre-seed investing today. These were mostly $1 million rounds, mostly pre-launch or very early product market fit companies, a lot of first-time founders. And that got us into some awesome companies like Postmates, Bit, Fungal, Shippo, Launch Darkly. It was really fun, but Steve, it was a small fund strategy.
Yeah.
Our strategy was 500 to 700K checks, 7 to 10%, relatively concentrated portfolio, and just stay early. And really with the Fitbit IPO and some other things in that portfolio that started to work, the lid came off. And, a fund that had challenges fundraising, suddenly LPs were like, well, how big do you want to make this thing? And, when I left Uncork, we'd raised an $85 million fund, and their last fund was 200 plus a $200 million kind of opportunities fund. And what I realized is that kind of very early investing in people and ideas is not a scalable part of the venture ecosystem. And I like doing that work, and I like working with first-time founders, but it's really hard to deploy more than $75 or $100 million per fund against those strategies because your initial tickets are just so small. And if you do too many deals, you'll dilute your return. And so I realized that Uncork was going to scale, and that the thing I wanted to do was the old work, not the new work. And so I left after being a partner for 5 years and put up my own shingle, only to realize that there was an enormous amount of resistance for the model that I was trying to convince LPs was a good idea.
I like to think that I tell my kids and business associates, the harder the lift, the bigger the reward, and the more doubters and haters. But, just curious, what do you think helped you get over that?
It's so funny. So I'm on the investment committee for a fund of funds called Screen Door that funds mostly first-time funds. And it's really funny. I was talking to somebody yesterday. They go, well, they asked me the same question. I go, it was very clear to me that entrepreneurs wanted this product. And the reason I ended up having the conviction to start it is Uncork went through this phase where we used to be kind of this angel, friends and family, kind of $500K to $1 million round investor to no, we're leading seed rounds. And as you know, Steve, when you change your marketing message in venture, it can take time for that to go through the ecosystem. So we were still having people who were coming in and be like, hey, I've got 250K left in my round. Do you want it? And I would explain to them, we don't do that anymore. And they would say, great, well, who's writing that check now that you're not? And I would say, I'm just drawing a blank. I don't know anybody. And they'd say, well, what about this firm? Nope, they scaled up. What about this firm? They also scaled up. What about that firm? No, they've also scaled up. And it became clear to me that I didn't even have a good place to send these people. And I'm like, I'm supposed to know. So if I don't know, either I'm doing a bad job of canvassing the landscape, or there really aren't places where I want to send these people for these smaller checks. I went into our fundraise thinking the single GP piece would be the biggest sticking point for LPs. So I'd spent a lot of time thinking, how are we going to address the fact that it's me and there's not a partnership? And I said, I got all these great other examples, Manu Kumar, Tim Connor, Steve Anderson. I'm not the first person to do this by any stretch. And it turned out I probably over-prepared for the solo GP question and under-prepared for the much more salient question, which was our portfolio construction. And we invest in 75 to 100 companies per fund. And for me, it was very easy to see how on a spreadsheet, a relatively small fund could generate really attractive returns with that portfolio construction because we had done it at Uncork. We'd had funds that had 65 companies in them. And I underestimated the LP resistance to that part of our model. Still to this day, the most common objection I hear when I talk to LPs is that they don't like the idea of that many positions in a fund, whether it's because our team is too small, whether they worry about diluted returns, whether they worship at the altar of concentration. For whatever reason, it is the big sticking point. And I think we've gotten better at explaining to people why they shouldn't fear portfolios that look like ours. But there's a significant chunk of the LP community who just does not believe.
Of course. And they also want to deploy at scale too.
That's
So
right.
they might be telling you one thing because because if what you're saying is true, sometimes they just can't move forward because if they do what you say you're doing, it kind of negates the other portion of their portfolio. And we've experienced that too at Alpha. It's like, if you accept our premise, then what are you doing? Zero the portfolio. I think about it like you want to have one side of your portfolio different than the other side, and even contrarian, because things might work out differently if you're a bit more contrarian. So like I've always thought that way, and it's unsurprising, but I'm a little surprised just because the first generation of what I would, derogatorily call spray and pray. I'm definitely from the old school cloth of I concentrate on, 20 companies or 10 companies or whatever it is. And my magic voodoo means that I'm going to hit that 1 in 10,000 shot with one of those 20 shots. And that's sort of the voodoo that I spin. But I think you better be able to tell a pretty good story that you can make a 10,000 foot shot with a high speed rifle without scope and heavy winds and hit that bullseye. But, folks like Josh Koppelman at First Round, he and some of his ilk kind of prove that, by the way, if you're doing seed stage and you're not investing in 50 companies, you're in trouble. You're likely not going to have a home run. And so I thought by now that argument would be kind of over. Of course you need to invest in 50 companies at the seed stage or pre-seed if you have any chance. If you're an angel investor and not doing 50 deals, you're crazy because the odds are high. But as you get to 50, the odds go higher up.
What I also tell them is, what are some of the constraints to concentration? It's usually board seat. There's a capacity per GP, and pre-product market fit companies are very different than Series A companies in terms of complexity, also in terms of what you can do to help those companies. So you can actually manage more of them. You couldn't do our model at Series A because the weight of board work and portfolio support, you would just drown. It'd be too much. Also, what I tell them is your fund is very power law. It ends up the top 10% of the portfolio are between 75 and 95% of the NAV for our current set of funds. And if I look at all of those companies, every single company we've invested in, I thought would be successful. And it's not as if the ones that end up working were obviously the ones that were going to work from day one. And I think there is some magic number between 50 and 100 companies per fund where you get the benefits of diversification, but you don't get beta, no pun intended, given the name of the podcast. And that's sort of what I tell at LPs is 50 to 100 is the optimal portfolio basket. And we are fortunate to have a couple of LPs like the folks at Virtus who've done a ton of research and deeply believe in our portfolio construction. And the real answer to your question, Steve, is that I found just enough people in the early days of our model who told me I wasn't crazy to keep going. So the founders gave me the sort of fuel to say, if I can raise this money, I know there's an audience of people looking for it. And some of the more brave LPs are a couple of big family offices. And I feel comfortable naming the Virtus folks because they've been pretty vocal about their belief in portfolio construction in their writing. But it was really finding a small handful of believers early who said, our first time was $15 million. It wasn't big. And that's candidly what we were able to raise. And that's the amount of dollars I was able to convince that this is an experiment worth running and that if you do this, it's going to work.
That's great. I often tell wannabe VCs, if you want to be a VC, It's pretty easy. Any jackass can become a VC. You just have to convince people to give you money at your discretion. And it turns out that's pretty hard to do. You have to have some real credibility. But that first $10, $15 million fund, if you're going to roll your own, that's really hard. You're talking true believers. You're talking about folks that trust you implicitly. I think it's a great way to begin. I mean, in a lot of ways, and you've scaled up a bit since then. What year was that again?
I started raising that fund in 2014 and we finished it in 20.
Great. Very cool. So you've been doing this a decade now.
It's funny that you mentioned the fund size. I often tell new fund managers too, I go, I'm really glad we had a $15 million first fund because it really gave me a chance to find my sea legs and to figure out like how to operate the business, not just how to invest. And I think if we'd had more money than that, it would have been more comfortable, but I'm not sure we would have made better decisions or that would have been the right start for us.
Yeah, every bullet in that portfolio matters because if you don't win, you can't waste a shot. Every shot matters. And I think they've shown that Fund 1s do pretty well because of that. Pretty high motivation. Your whole career depends on your success. Even Fund 2 and Fund 3, I think those also outperform just because so much is riding on those early decisions. If you could pull like one or two companies out from that, what was the best journey so far? I often say that seed stage and especially inception stage VCs have a lot tougher life than most people think. You spend a lot of times basically burying companies because they don't work, right?
The other thing that's tough is that, at least under our model, the faster companies start to scale, actually, the less time I get to spend with them because they graduate. If I think about a couple, they'll always have as a sports fan, the journey with The Athletic will always feel special to me just because Adam and Alex, that was our first fund. It was a category that wasn't very in favor when we invested in it. And just like two really awesome founders. And, I often wonder how much bigger that business could have gotten if we hadn't lost a year of sports. But that being said, I'm still very happy with the outcome, having sold it to the New York Times. I'd say the journey with Bobby Baby, which is a infant formula company, has been really awesome just because, the FDA shut the company down for an entire year early in its journey. And for a lesser company, that would have probably been the end due to a really resilient team and some investors who had, cast iron stomachs. The company was able to come out the other side. And I'm pretty confident it'll end up being one of the very best investments we've ever made. Impact on society aside, it just is a purely financial investment. It's going to end up being.
That's awesome. So tell me, at that very beginning inception type state, are you talking about a piece of paper? Is it an idea? Yeah. Is the corporation even formed? Do you have any competitors at that point? Is it just, hey, either we're in business or different?
We certainly have had cases where we haven't been able to wire the money because the company doesn't have a bank account because they haven't finished the incorporation process. Certainly had those. I'd say the more prototypical case, it's somebody has an idea and they've spent some time thinking about the idea and the contours of it. And they can talk to me for an hour about why it's a good idea. But they usually don't have anything tangible they can point to. There's no public version of the product. Maybe there's wireframes in Figma. Maybe there's a looks like clickable prototype or there's something in Canva. But usually there is not something I can independently play with. And there's usually not, months worth of cohort data to analyze. We are making a directional bet on two things. One, the quality of the management of that company and their ability to scale and become the leaders the company needs, and their assessment of the market opportunity and the product that they plan. And in some ways, it simplifies life because those are the two things we spend our time. And usually they're in a market where there are some competitors or there's some existing firms where you should have some point of view about why those firms are successful and where they might be vulnerable. So I think oftentimes you can decide, do I /trust these people enough and their analysis? You can figure that out in one or two meetings.
Right. I was going to say, when you've got wireframes, do you have is it more like being an artist and saying, you know what, you got it going on. I like your style. Is there anything that more pilot where you're check, can code or check, can look at me in the eye or check.
So over time, we've developed a checklist of things that we go over. It's a mix of quantitative and qualitative. For example, one of the things that we have found, we've made over 450 investments. Almost all of our most successful companies, the founders worked at a startup before. Oftentimes they were not the founder. In many cases, they were not the executive. It also turns out it doesn't actually matter if the company was like a wild success. And my takeaway from this data, what it tells me is that operating in a 0 to 1 startup is a unique experience and skill. And what we found is we backed a bunch of talented people who've come out of the big tech companies, and they have struggled with 0 to 1. And I think it's just they don't know how to operate in that environment. And the things that made them successful in their big tech jobs don't translate to from scratch companies. So in many cases, if the team doesn't have recent startup experience, I get very nervous that they don't actually understand what they've signed up for. And it's not an automatic disqualifier, but it's a pretty heavy thumb on the scale for me to like make sure that I really believe. And then we score people behind the scenes on a bunch of attributes. And they're all subjective: leadership ability, ability to recruit, problem solving, ability to articulate the thing that they want to build and why it matters. And I have this gigantic histogram that puts people into buckets based on the quantitative stuff. And that just tells me, who do they look like? Like, who else is in that bin? And what have I learned about people who are in that bin? But most of it is subjective. The quantitative stuff is 25, 30% of the analysis.
I know that you're like, oh, well, you know, I'm at Stanford. I think I should be in part of this. Is that part of that? Like, so someone from like, I mean, have most of your investments been local?
At peak, we've been like 2/3 California. At the bottom, we've been 40. About half of it's Bay Area. If you add up Bay Area plus New York, that usually accounts for 2/3 to 3/4 of our investments, which means a third of them are not in those places. And what I always tell founders is, if you're a first-time founder and you're trying to build something from scratch for the first time, your life will be easier on the business side. I'm not talking about housing prices. I'm not talking about your romantic life. I'm not talking about proximity to family. I'm purely talking about company building. It is easier to do it in places where there is density. And depending on what you're building, the density is probably in some place where the other people building like you and the capital that wants to fund them are co-located. The one thing we do now that we didn't do before in this environment is, you asked about teams and are there sort of no-go things. I'm very hesitant to invest in pre-product market fit teams that haven't worked together, that are not co-located. If you've worked together and you have some shared DNA and you choose not to be in the same place, I think you're making your life harder, but there's like rhythm and DNA there. If you haven't worked with the person before and you're not in the same place, there needs to be a really compelling reason why, like cost of living or like sick family member or partner who's in some kind of there needs to be a very compelling reason why you're not in the same physical.
I was just kind of curious. And as I was going through your bio, and especially sort of, there just seems to be like especially with the Trump election, tearing out DEI out of the federal government. I was just sort of curious, like, what's your hot take in terms of like how that applies to what you like, not what Trump is doing, but how you look at that in your experience. I'd love to kind of get a sense from you. I can share with you, I'm Jewish by background, European, second, third generation immigrant. I personally don't spend a ton of time parsing through what someone's background is so much. And we focus on growth stage. So like that, we're mostly focused on the businesses. There's numbers and everything else. And you grow a company from 10 to 50 million. I don't really care too much about who you are, but I was just curious in terms of, I think to a certain extent, I have an affinity with in New York, you know, I think 1/3 of the population is Jewish. So when I was running a venture fund, it wasn't unusual to run into someone who was Jewish, but it wasn't because, oh, I'm going to go invest in them. I was just sort of curious how you think about that.
I've always felt like I wanted to build a firm that was open and accessible to everyone. I've been in the venture ecosystem and tech for 25 years. And when I first got in, I think everyone's like, this is totally fair. This is very open. We just pick the best ideas. I'm like, well, then why do we only pick a very specific type of person? Are all of the good ideas contained? And if you think about it, like, you know, venture used to be, you have to be in the Bay Area and you have to go to Menlo Park for these meetings and you have to know somebody to get a warm intro. And I think naively people said, well, we are picking the best ideas out of the people who can navigate all of these hoops. one thing I decided from the beginning was we were not going to be a fund that only funded any one type of person. And for a bunch of reasons, most of which were like, I think it's really interesting to create a space where people from different backgrounds can get to know each other. And entrepreneurship is actually a pretty safe topic for bridging differences. Like if you're a Black female founder and you're like a white male founder and you're both trying to start companies, you actually have a lot in common. You actually have things to talk about that are not politics, that are not religion. You have the shared language of entrepreneurship. And I looked at the data and said, look, female founders aren't getting a lot of money. Founders of colors aren't getting a lot of money. So there's probably like a couple of possible explanations. One is they just systematically have bad ideas and they're not getting funded because of stuff. I was like, I find that hard to believe that like 50% of the population is so bad at producing ideas that they only get 2%. That doesn't make any sense to me. I was like, some of this is about social access and like having someone who's willing to work with them and meet people where they are. I was also like, there's a lot of white entrepreneurs I meet who didn't go to Stanford or Harvard, who moved to the Bay Area and who also don't have connections. And they might have a slightly easier time because there's sometimes the cultural affinity between them and the person across the table. And they can maybe see themselves in that person, but they don't have an easy time either. And I was like, what if we just said we're going to focus on the people who don't have an easy time? Because the people who have an easy time are very well served. And you could maybe not have an easy time because you're a member of the LGBTQIA population. You could have maybe not have an easy time because you have a learning difference. You could have a physical disability. You could be from a race or gender of people who don't typically get these opportunities. I'm like, we're just going to focus on the people who are not well covered, because they're not getting underwritten. And if you fall in that bucket, great. But we're also going to leave room for people who are well covered, who want our money. And I think I've never worried about the tide of DEI. I'm like, because we really are trying to build a firm that includes everybody. We don't have any exclusionary language in our model or on our website. And we fund a lot of like 2-man white teams. We do. And I'm like, they have a role in our fund too. And so my goal is to build a fund where everybody feels welcome and where everybody sees themselves as part of our community. And I've seen some really cool friendships and relationships develop across differences, political, racial, ideological, through the experience of like working on companies together and trying to help each other as fellow entrepreneurs in the journey.
Great. I appreciate that. And I just always, I felt that, you know, in that context, I hear what you're saying though about the access, and just thinking about myself selfishly, I wasn't part of that Harvard, Stanford community. It feels like in today's world, I'm not so sure people really care too much about it, but I think there's definitely that element and that edge. But I think there's been too many, to your point about a monopoly on great ideas, there are too many situations that I've been involved with over the last 25 years where you had the right phenotype on paper, but it didn't work out. So like, hold on a second, go back and check your notes. And I don't think that's very important, but I do think entrepreneurship is a huge leveler in terms of inequality.
Yeah.
It's definitely become more of a force for equality. I mean, if you look at immigrants can't get the types of jobs that locals can get because of their lack of roots. So they spin something up on their own. It actually worked out. I think that's the power of venture capital in a huge way. Let's touch on talking about sort of today's environment. I'd love to get your sense on AI, of course, and what that means to you guys, how you think about it. And then also talking about your sort of risk on, risk off. It feels like those are two topics that are kind of rotating around each other. Like, is it risky to be in AI? Is it risky not to be in AI? So I'd love to get your hot take on those topics.
The AI thing has been probably the biggest challenge we've faced as a firm in the 10 years I've been doing this. Because a lot of the AI stuff, it's funny, I wrote a post maybe 2 years ago. I was like, this is just my honest take. Like, I don't understand the defensibility or moat of most of the things that I'm seeing in AI. Most of the founders I'm meeting are telling me they built these products over a weekend. The infrastructure in which they're building is changing so rapidly. It's unclear to me, like, whether something that's a problem today will even be a problem by the time we wire this capital. Like, how do you invest in infrastructure when the infrastructure is not stable? How do you invest in applications when it's not clear that there's a moat? And a bunch of my friends were like, okay, Mr. AI Chicken Little, I was like, no, I really have, these are like, I'm taking a risk and saying, I honestly have these questions and I don't know how to answer them. And we spent a lot of time as a team thinking about these issues. And I spent a lot of time talking to my friends who are building foundation models or an AI infrastructure about these issues. And there's one other confounding variable, Steve, which is a lot of the people I met who were qualified to start AI companies were not going to raise a $1 million pre-seed round. So we had this environment where all of the big money, multi-stage money, was kind of piling into AI. And I don't know if you had this experience. There were times last year where I talked to my friends. They said, the only thing we're looking at as a firm are AI deals. If you send me anything that is not an AI deal, there is like no interest in our partners. And I was like, are you serious? He's like, I know it sounds extreme. It's the only thing that people care about right now. And I was like, we have so many questions. Our firm does not operate that way. We weren't going to chase the really expensive, multi-$100 million pre-product market fit, very talented AI researcher opportunity. I don't even know if we would have gotten into those candidly if we'd wanted to. But we decided that's not our business. And a lot of the application stuff that was raising small amounts of money, it just felt very red ocean, highly competitive, limited differentiation. So we said, it is untenable to do 0 AI deals. That's not tenable. But we are not going to do AI deals for the sake of them. We're going to find entrepreneurs that we believe in, who we think have a reasonable view of how this is all going to play out. And the analogy I've told my team is almost everything we thought would work in the internet in 2000 works today. You can buy plane tickets, even things we couldn't even envision, like Uber. You can buy groceries. It wasn't Webvan that won. It was Instacart. Like, I could name a bunch of things. It wasn't broadcast.com that won. It was the stream. All of these things had antecedents. And I could say the same thing about mobile. Every tech revolution, this happens. And yes, AI is compounding faster, but I'm not convinced that we won't look back in 2 years and go, gosh, there are a bunch of companies that had the right idea, but boy, was that early. The necessary ingredients of like human behavior and technology weren't right. The problem with our strategy, though, is all of the markups right now are in AI. So if you're a seed stage investor in AI and you pick well, you're getting 2 and 3x. It feels like SaaS did when people were paying 100x for multiples on SaaS. If you were in a hot SaaS company as a seed investor, you were seeing rapid multiple markups. And as you know, Steve, we all invest in a competitive landscape, and I have to compare my performance to my peers. And there are people who I know who've gone all in on AI. They've made a different decision than we have. And I look at their unrealized performance and I'm like, that looks pretty good. Frankly, it looks better than what I could put on paper right now, but very little of it's liquid. And we don't know what's on the other side of this curve. So it's been very hard to sort of be more conservative on AI, while at the same time running a firm that is committed to investing in first-time founders, pre-product market fit, where after the big valuation resets in 2022, a lot of firms said, if we're going to do early stage, we are going to demand more. We're going to want to see product where maybe we didn't care about seeing product before. We're going to demand revenue, or maybe we didn't care about that before. And we've kind of gone the other way. In some ways, we've like run into the dangerous building and just said, we are going to continue to back first-time founders who don't have product. And it's made syndicating hard. I look around and I'm like, well, where'd everybody go? And I'm like, oh, they went upstream. They went to the companies that have it. And that's been an easier position to maintain than our sort of one on AI.
Got it. I mean, you have done some investments
Absolutely.
in AI, right? Like, looks like Rewind and Deep Discovery and Dana podcast.
Ironically, probably our best AI investment is a company called the Rad AI.
We're in that with you guys too. That's really, remarkable. Do you think like you were at that pre-seed level, I presume? And is now the time to like maybe not on Rad AI, but you get a $400 million, billion valuation? I mean, back in my day, we would have pulled the ripcord and been like, hey, hallelujah.
The one area where I have real scars at Precursor is we did not do enough selling in 2021.
Right.
We had at least one company that would have returned the entire fund if we'd sold the position, and we didn't. And I will never forget that. And we have changed our belief system around secondaries. And I tell our LPs all the time, there's only so many great companies per fund. And if I sell out of them too soon, you'll get money sooner, but you'll get less of it in the end. But I'm no longer willing to let it ride forever. So we've gotten to a place where usually when things start to get into the hundreds of millions of dollars of valuation, we're like, we should sell a portion of our position, well less than half, but a portion. And we should monetize that position. And I would much rather be in a position where we go, gosh, we could have made 4 times more of our money if we held that, than looking back and saying, well, something that was going to be if it was going to 3x the fund is now a 0.
That's not cool
at all. And we learned that lesson in 2021. And I think we're a permanently changed firm for it.
Yeah, I think a lot of folks are thinking about it. So you're taking some cookies off the table as you go.
As long as it doesn't create tension with the founder. Thankfully, the times we've done it to date, it's either been alongside a founder or with their blessing. We haven't had one where we were like, hey, we got to get out. And the founder's like, hey, this is like not a great. I imagine we will have one of those conversations at some point. But to date, it's been always in partnership with the founder or with the new lead.
Now, you said something about being risk on versus most VCs being risk off. Can you share a little bit more about that?
I've met a bunch of pre-seed founders who are like, you're a breath of fresh air because you'll invest before we have a product in traction. I go, well, what are you hearing from other pre-seed funds? And I have a friend who told me that their new bar is 10K in MRR for pre-seed as something else. Right. And he's like, that's our bar now. And we're a pre-seed firm. And I think the thing that I've had to reckon with lately is when I started Precursor 10 years ago, there was no pre-seed market. There were a handful of firms that were doing this style of investing. And pre-seed was kind of what we said it was. The term hadn't been co-opted. And now I feel like there's a bunch of people who call themselves pre-seed firms because they want to see people early and they want a first look. But really, the standards that they're holding these companies to are more like early seed. And so I've met a lot of founders who have a great deal of frustration. Like I meet these pre-seed firms and they tell me I need to have a complete team, a live product, and 5 to 10K MRR minimum. And they're like, well, how am I supposed to do that with no money?
We talked about that have been on people's minds lately, and especially with the downturn and difficulty for, in the venture capital industry. It hurts entrepreneurs, but it also hurts VCs to a degree. There's definitely a tension between the role of multi-stage firms and seed stage firms. How do you think that's changing? How do you think that's going to evolve? And love to get your thoughts on that.
Yeah, I feel like I had a front row seat to the early days of seed when I worked at Uncork/Softtech with Jeff Clavier back in the sort of early 2010s. And back then, seed really did feel like this very small, boutique, distinct corner of venture that really wasn't that interesting as a main event investing activity for multi-stage funds. And over the 2010s, there were times where the multi-stage funds were enthusiastic about seed and they would come in and make a bunch of investments. And then I think they would realize this is a lot of work and maybe this is not as interesting as Series A investing. Let's stop seed. And then seed would get hot again. We went through this cycle of seed funds of multi-stage funds dabbling in seed investing. And as a seed investor, I think it was pretty easy to tell an entrepreneur, do you really want this tourist multi-stage money? They run hot and cold on seed. Right now they're interested. They're not going to get any time from the partners. There was a sort of long list of objections that a seed fund could roll out and make to an entrepreneur about why they didn't really want that capital. And about 5 years ago, I felt like things changed. It felt to me that the big funds were able to raise dedicated vehicles to exclusively focus on seed stage investing, that they were committed to building practices that would not run hot and cold, but that would be kind of more permanent. The bigger change was, in many cases, the way they were deploying these seed strategies was as a way to get to know entrepreneurs better in advance of a Series A financing, and less about an independent money-making activity on its own, which isn't to say they weren't interested in making money, because they obviously are. But if you think about a seed fund, that's your entry point. The price you pay getting in and the amount of equity you can buy up front has a huge determination on your future returns, because the odds that you're going to buy up in the A are pretty low. If you're a multi-stage fund, seed is one of many opportunities you will have to buy more equity in the company. So to some extent, if you're a multi-stage fund, the way you think about price and round size and check size and seed is very different than what a dedicated seed fund manager would think about. And there's some tension in the model there. And what I've seen play out is a lot of founders who are repeat founders who are coming out of big, well-established companies are, making the world competitive for smaller seed funds, because they're saying, hey, You've got a great dedicated seed product, but there's a big multi-stage Sandhill Road firm over here that's offering me twice as much money at double the valuation. Tell me why I should go with you. And the multi-stage funds don't win every one of those battles, but they certainly win more of them than they used to. And I think if you're a seed fund, I think you have to ask yourself, what does it mean for me to be successful in a world where the big Sandhill Road multi-stage funds are probably a permanent fixture in seed stage investing as opposed to just tourists?
All right. So what's the best way for an entrepreneur to reach out to you? He's got a piece of paper and an idea.
I read all of my emails. So I'm just Charles at precursorvc.com. Also, we have a website at precursorvc.com where you could submit your plan. And everybody on our team does a tour of duty on a regular basis looking at the website submissions. So if you submit from the web, we get back to almost everybody within 2 weeks. You can go from the website to a meeting with me. It is not a black hole.
How many opportunities a year do you guys peruse?
6,000 last year.
Wow. That's pretty remote. That's a lot. Do you use AI?
We don't.
To like
Now, truthfully, there's a chunk of those that get automatically disqualified because they're in regions or sectors that we can't invest. We have a way to filter those out, but the rest of them, a human looks at them and tries to make a determination as to do we have a portfolio conflict? Is it the right stage? Ironically, because of AI, I feel like some of the volume increase we're seeing is AI tooling that makes it easier for founders to send things to us. So we have not decided to participate in the arms race of turning AI against these AI submissions. So
great. Well, Charles, this is phenomenal. It's great to do this deep dive with you. So great to meet you in this forum. And thank you so much for sharing your wisdom with us and our listeners. Thanks again, Charles Hudson from Precursor Ventures. And we'll see you soon.
Thanks for listening to the Driving Alpha podcast, where we host top investors to demonstrate how they outperform the market. Click subscribe so you don't miss future episodes. Driving Alpha is supported by Affinity, provider of the CRM for the private capital relationship economy. Affinity knows who has the best relationship with the right startup. Affinity knows. Learn more at affinity.co/driving alpha.